What if I told you that one phone call, one name, one decision made inside Washington, D.C. could wipe billions of dollars off your investment portfolio before you even finish your morning coffee? This is not a movie trailer. This already happened, and right now most people have absolutely no idea why their stocks dropped, why Bitcoin tanked, why their 401k looks like it went through a blender, and more importantly, whether it's going to get worse. Here's what's scary. The people who do understand what's happening, they're quietly repositioning right now. While everyone else is panicking, refreshing their Robinhood app, posting what is happening on Reddit, a small group of people who actually understand the system are making moves. So here's your choice. You can close this video right now, stay confused, and hope things magically recover. Or you stay with me for the next few minutes, and I'm going to break down exactly what happened, why it happened, and what smart money is actually doing about it. Because by the end of this video, you're going to understand the US financial system better than 95% of Americans. And that knowledge, that's the real investment. My name is Dave, and this is Dave Invests Smart. And if you're new here, hit that subscribe button right now, because this channel exists for one reason only: to make sure you never get blindsided by money news again. Alright, let's get into it. It all started with a name, Kevin Warsh. The rumor began spreading fast that Donald Trump is planning to replace Jerome Powell as the chair of the Federal Reserve with Kevin Warsh. And the moment that name started circulating, markets moved hard. But here's what most people don't understand. It's not just about two guys switching chairs. This is about the entire philosophy of how America handles money. And your portfolio, your crypto, your home value, all of it sits on top of that philosophy like a house built on sand. So let me give you the big picture first. Because once you get this, everything else clicks. The Federal Reserve, the Fed, is the central bank of the United States. Think of it as the control room of the entire economy. It doesn't make products, it doesn't sell anything, but it controls something more powerful than any product on earth. It controls the cost of money. The Fed controls interest rates, and interest rates control everything. Here's how simple this actually is. When interest rates go down, borrowing becomes cheap. Companies borrow to expand. Regular people take loans to buy homes and cars. Investors pour money into stocks and crypto because savings accounts pay nothing. Everything goes up. When rates go up, borrowing gets expensive. Companies slow down. People stop spending. Investors pull money out of risky assets and park it somewhere safe. Everything comes down. That's it. That's the whole game. And the person who controls interest rates, the Fed chair. That one human being has more influence over your financial life than your boss, your bank, or honestly, even your own spending habits. So now let's talk about Jerome Powell, the current Fed chair, the guy Trump apparently wants to replace. Powell is what Wall Street calls a predictable operator. He's not flashy. He doesn't make wild moves. Markets basically know what he's going to do before he does it. And markets love that. Certainty is the most valuable thing in finance. Even bad news, if it's predictable bad news, doesn't destroy markets. Powell's whole approach has been keep money flowing. If there's a problem, print more money, lower rates, inject liquidity. Keep the patient alive. Think of it like a slow, steady rain that keeps the fields green. Not perfect, but consistent. Now enter Kevin Warsh. Warsh was a Fed governor during the 2008 financial crisis. Smart guy, respected guy. But here's his philosophy, and this is the part that made markets sweat. Warsh is an inflation hawk. That means he doesn't like excessive money printing. He wants a stronger dollar. He prefers tighter policy. His approach is more like, don't water the fields every day. Let it get dry. Then when a real crisis hits, flood everything. Now think about that from a market perspective. No more predictable slow drip of cheap money. Instead, long periods of drought, then a flood you can't predict or prepare for. Markets hate that. Investors hate that. And that's exactly why the moment Warsh's name dropped, traders started selling. Here's where it gets psychologically interesting. And this is what most finance videos completely miss. Markets don't crash because of bad news. Read that again. Markets crash because of uncertainty. Bad but predictable, markets handle it. Uncertain future with no clear direction, markets panic. And a Fed chair replacement is the single highest uncertainty event that can happen in financial markets. Because it doesn't just change one policy, it potentially changes the entire operating system of how money flows through America. That's why stocks fell. That's why Bitcoin fell. That's why gold wobbled. Not because things are suddenly terrible. Because nobody could answer the most basic question, what happens next? Now let's talk about Bitcoin specifically, because a lot of people are confused right now. I thought Bitcoin was supposed to be a hedge against inflation. Why did it fall? Great question. And this is where most crypto influencers will lie to you. So let me be straight. Bitcoin behaves like digital gold sometimes, but most of the time, Bitcoin behaves like a high-risk tech stock. When uncertainty hits the market, investors go into what's called risk-off mode. They move out of risky assets, crypto, growth stocks, speculative plays, and into cash or bonds. Bitcoin gets sold first, not last, first. And now with Bitcoin ETFs in the picture, there's another layer. When investors sell a Bitcoin ETF, the ETF manager has to actually sell real Bitcoin to cover those redemptions. So you get a chain reaction. Selling triggers more selling triggers more selling. The feedback loop is brutal. So no, Bitcoin is not a perfect inflation hedge right now. It's a volatile risk asset that also happens to have inflation hedge properties. Big difference. Let me quickly address the Michael Saylor fear because it's all over the internet right now. MicroStrategy, Saylor's company, owns an enormous amount of Bitcoin, billions worth, and people are terrified if the price falls too far. Will he be forced to sell? Will that crash the entire market? Here's the reality. Saylor structured his debt using long-term convertible bonds. This is not margin trading. There's no automatic liquidation trigger that forces him to dump Bitcoin tomorrow morning. The structure gives him time. Years, not days. Is it zero risk? No, but the Saylor liquidation equals crypto apocalypse story is mostly being pushed by people who want you to panic so they can buy your Bitcoin at the bottom. Don't hand it to them. Okay, so what does smart money actually do right now? Let me give you the same three-part framework that Dave uses every single time markets go crazy. Number 1, zoom out. Always zoom out. The stock market drops 10 to 20% almost every single year. And yet, over any 10-year period in modern history, the market has gone up. Corrections are not disasters. They are sales. And you wouldn't panic and return your groceries because the store had a sale, would you? Number 2, understand the liquidity cycle. Everything in markets comes down to one word: liquidity. How much money is flowing through the system? When the Fed is loose, liquidity rises and asset prices go up. When the Fed tightens, liquidity shrinks and prices fall. Right now we're in a period of uncertainty about future liquidity. That's it. When clarity returns, and it always does, markets stabilize. Number 3, do not time the market. The most expensive words in investing history are "I'll wait until things calm down," because by the time things calm down, prices are already back up. Smart investors use dollar-cost averaging, investing fixed amounts consistently regardless of what the market is doing. It removes emotion. It removes timing risk. It builds wealth quietly while everyone else is screaming on Twitter. Here's the big picture truth that I want you to carry with you. We are living through a period where trust in big systems is cracking. The Fed's credibility, the dollar's dominance, the predictability of government policy. These are all being questioned at the same time. And when trust in systems cracks, hard assets win: real estate, energy, gold. And yes, Bitcoin, not as a get-rich scheme but as a long-term store of value outside the traditional system. But none of that matters if you panic sell every time a name drops on a news headline. The investors who build real wealth, they don't react to news, they understand systems, they position early, they hold with conviction, and they let the panicking masses fund their long-term gains. So here's your takeaway from today. One name, Kevin Warsh, caused global market turbulence because it threatened the liquidity system that has been driving asset prices for over a decade. Markets didn't fall because of facts. They fell because of fear of the unknown. Bitcoin fell because it's still primarily a risk asset, not a pure inflation hedge. And Michael Saylor is not the ticking time bomb the internet wants him to be. The real move: stay calm. Stay consistent. Keep learning, because the most powerful financial tool you have isn't your brokerage account. It's your understanding of how money actually works. And that's exactly what this channel is built to give you every single week. If this video helped you see the market differently, hit subscribe, hit the like button, share it with one friend who's currently panicking about their portfolio, because they need this more than they need another doom headline. Dave out. See you in the next one.